Hey guys, Whitney here. Welcome. I've got several people that are still trying to make it in from the waiting room. If you would find your chat box, this is where I want you dropping all your questions for today. And make sure that you can let me know that you can hear me and see me. That'd be fantastic. Yoo-hoo! Thank you, Frankie. I assume you can hear me too, since you went over there as well to let me know. Awesome. Well, I'm gonna hold on, my computer got disconnected real fast. Hold on, guys. All right. Woohoo, technology. Okay, so I got a couple of people still joining. We're gonna go ahead and get started. This is a repeat of one of my most popular sessions in the series I do, How to Get Started as a Passive Investor. So let's go ahead and start diving in here. Basically today we're gonna cover one of the biggest myths when it comes to passive investing. We're also going to learn how to understand if a deal is a good deal in under about 10 minutes. Okay, now this 10-minute due diligence chart I'm going to share with you is not all the due diligence you should do, but it's a good primer and a good screener. And then we're going to learn what to look for when reviewing an investment summary. So if we got time, I'm going to pull up an investment summary of a deal that's closed in our portfolio, and we can start walking you through where to find all this different information in one of our investment summaries. Okay. But if this is your first webinar, guys, welcome. I do this webinar series, every week. So make sure you join every week. The topics change. And basically, I do this series if you've tried investing in passive syndications before, but maybe got cold feet, couldn't pull the trigger. Or maybe you've actually invested in a deal before and you're like, uh-oh, I made a mistake. Or maybe you're just like, you want to invest and you're just so overwhelmed by all the information out there, you don't even know where to start. So if any of this applies to you, you're in the right place. So let's first pick apart the biggest myth when it comes to investing passively. And this usually applies to investors who have started investing in their own real estate portfolio and then switch over to passive investing. They feel the biggest lie they tell themselves is like, I have no control over the asset. And you know what? This mindset actually keeps people sidelined and keeps them from scaling their real estate investments. And I'm going to show you today what we're tackling today will help kind of bust through this this mindset disbelief. Okay, this big lie that people tell themselves. Okay. Hey guys, we got a ton of people on. If you would keep your cameras off, things will stream much faster for you, as well as keep your mics off. And just if you have questions, jump over to the chat box and type them in there. I don't want you holding on to your question. I'm going to do my best to answer questions within the flow of the presentation. If not, I'm going to stay on and we'll clean them all up later for sure. But again, if this is one of your first times joining, I'm Whitney. I'm the Director of Investor Relations and Operations here at Goodegg. And here's me and my crazy crew. This photo, I cannot believe, is over a year old now. This was their last out of the country adventure in Mexico. My daughter had made it to the top, climbed the top of the Koba pyramid, which if you've ever been to the top of that pyramid, OSHA rules do not apply. Anyways, so, and I also, for some reason, I got two slides. This is me and my family, and we spent the winter here in Sedona. So both of these pictures just really illustrate why I invest in real estate. Is the power of real estate investing is that it allows me to be with my family and travel more. And just the power of passive income. I started off investing, doing live-in flipping and house hacking, and it was great at building wealth, as far as like buckets of money at a time, but really hard to pay your bills. And so, I built up a portfolio of 30 single family rentals. Most of those burr rentals. Also, my husband and I did a few $1 million in flipping. Again, that allowed us to build up capital and start converting that into passive income. But it didn't really help us scale that immensely. And it's when we stumbled upon passive syndication and how we could start investing in larger projects through multifamily, that's when the rubber really met the road for us. And again, all of this helps me meet my goals to spend more time with my family, build passive income and generational wealth. So fast forward in just over 2.5 years with Goodegg, we're coming up on our 3rd birthday. We've acquired over 26 multifamily properties, over 6,700 units under management, and an $800 million portfolio. But what I get to do every single day is work with our investors. So we have over 770 verified investors, okay? These are people that are I've actually spoken to. That's a lot of phone calls, guys. And we have a very high repeat investment rate. And, here's just a few things that, we've been able to tackle here in the last year. We put out our book. We also put out our podcast. We actually are rebranding the podcast to Life and Money. We feel that's going to be more appropriate for what we are trying to do and help our investors achieve. We've also met with many of our operators and many of you guys too at various conferences, both in person and online, even in the midst of COVID. So a quick recap, guys. I've been doing this series for almost a year. And, just to, I think every online presentation these days has a disclaimer. I do this series for your education. You're going to have tons of questions related to legal, financial, or tax. Feel free to ask the question, but just know you need to consult with a legal, financial, or tax professional for all of these questions because you need to know how these different levers apply to you, how you can implement them in your own personal situation. But if you are just starting out, I am recording this presentation. When you get the replay email, look for these initial presentations that I did. This is kind of the base foundation. I highly suggest any investor recap prior to investing in any syndication investments. Go ahead and take a screenshot of this because that'll help you, when you see that long replay list, you're going to be like, man, this is a lot. Like, where do I need to start? Look at these things and possibly in this order as well. Okay. Now, we talked number 1 and number 2. Earlier this year, I recapped the 4 tenets of conservative investing and the 3 secrets of control. I'm going to pop these up here real fast because this is going to feed our conversation today. So remember, one of our biggest lies that investors tell themselves, the reason why they can't get into syndicated investment is they lack control. However, you actually get an immense amount of control before you ever invest. 1, you get to choose the operator you work with and the investment strategy that operator is doing. Okay, so you're planning, you have control. This requires you that you know your goals though. I just got off the phone with an investor right before this, and the gentleman had his whole investing plan laid out. He knew his goals right down to a T, and we were able to rule in and rule out very quickly whether we were a good fit. So know your goals, and that'll help you choose the operator. Also, you want to know what market you should be going into, okay? We here at Goodegg, we love growth markets. We want to be in markets where the population's growing, income's growing, jobs are diversified, housing is affordable and increasing, rents are affordable and increasing, taxes are favorable, landlord-tenant laws are favorable. Very important right now when we're in this COVID environment. And think of this as a sales funnel. You're going to choose your operator, you're going to filter them down based on the market, then you're going to choose your deal. You have an immense amount of control as you go into your investment, okay? And this, number 3, is where we're going to spend a lot of time today. Now, here is another lens to look through, and that's the 4 tenets of conservative investing. This here is our investment philosophy here at Goodegg. We invest in primarily for capital preservation, okay? Rule number 1, Warren Buffett's rule number 1 in investing, don't lose money. Rule number 2, see rule number 1, okay? Also, we invest for cash flow, okay? Cash flow is king. I don't care, for me personally, I don't care what asset class you're in, especially in an up market or a down market, It's the cash flow of the asset that's going to allow you to hold on for the ride, whatever ride you're on. Number three, we look for assets that are going to appreciate. We want to pull as many of these net operating income growth levers as we possibly can. We want to be able to grow the rental income on the asset. We want to be able to decrease our expenses, and we want to be able to add additional streams of income. This number three right here is probably the biggest differentiator between small single family and small multifamily investing and larger commercial investing. Because the small single family homes, especially 1 to 4, and I challenge even up to 50 units, those are going to be driven based on what the market says it's worth, okay? Not actual NOI income, okay? All right, tax benefits. You get the exact same tax benefits as you would in smaller investing here in commercial real estate. So of course, we love these tax benefits here. The cool thing is we get to do what we call a cost segregation analysis. It's actually a little bit more economic to do this on a larger property and accelerate losses to the early years of the project. I am so thrilled. You can actually you can do cost segregation analyses on your smaller single family properties. It just, you have to weigh whether it is a good financial investment, because they can be a little costly. Okay. So now that we've understand what our funnel is, our 3 secrets, okay, and we're getting down to how to look at the deal and the lens, the 4 tenets of conservative investing, the lens we're going to look through as we look at the deal. Let's dive into the deal. Okay, how do we actually, when a deal lands in our inbox, how do we actually open this up and go, huh, I think I want to learn more about this deal, and this is a good initial deal for me to be in. All right. First, you need to know, before you look at any deal, I'm going to hammer this home, guys, you need to know the operator and you need to understand the market. If you don't know those 2 pieces first, okay, put on the brakes, research the operator in the market. I don't care how good the deal numbers are. You start with the operator in the market. I can't tell you how many other syndicator lists I've ended up on, and I get a deal in my inbox and I'm like, who is this from? I don't understand. Okay. If I don't know the operator, I am going to start here first and make sure I research the operator, and I'm going to make sure that it aligns with the market that I actually want to be in. Okay. All right. Then we're going to get down to the deal itself. All right. Now, this slide here is, and we're going to walk through this. We're going to put this in play. When we're looking at a deal, I'm going to give you guys a checklist here in a second that you guys can take a screenshot of. You should have an investment summary. Okay. An investment summary is a marketing tool. Okay. Any operator can make an investment summary like look amazing and really impress you. But we want to see beyond that beautiful marketing tool and actually get into the nitty-gritty. And for here, we're going to be looking at the executive summary, okay? Probably 3 or 4 pages in. That executive summary should have a highlight of the returns on the asset, the investing plan. Is it a value add? Is it a development deal? Is it a buy and hold? It should indicate to you really quickly what kind of loan or how the loan is going to impact the deal. And then the general like overall structure of the deal. Like, is there a 7% pref? Is there a 70-30 structure? All of this should be recapped in the executive summary. Again, giving you the very highlights, okay? But we don't want to stop there, okay? Because we can glean a lot of different information from other parts of the investment summary, all right? Then in the next section you're gonna get is the investment offering section. And in this section, they're going to recap, the operator is going to recap why they think this is a good deal, okay? Your job, if you guys were on for the webinar last week that we did with Mark Holder, you know, the lawyer that heads up KKOS Lawyers, he made an amazing point. Like, you don't want to be, you want to confirm everything that that operator is telling you, okay? They're going to tell you why they think it's a good deal. You want to dig in and want to challenge why it's not a good deal. Okay, you want to play a little bit of devil's advocate. Also, in this investment offering section, they should name what they call the break-even occupancy of the deal. Okay, So at what occupancy are all expenses covered? Okay. Now, keep in mind, expenses include everything on the T12, trailing 12 financials, as well as the debt of the property. It does not include the limited partner, distributions to the limited partner. Why? Because you and I are partners. We're sharing in profit. Limited partners are not an expense of the property. Okay. Limited partners are not debt. I think that's one of the biggest kind of like misconceptions that I am continually driving home in making sure that our investors understand. We are partners. Partners, we share in the ups and the downs together. All right. The next section is going to be the property overview. Again, this can look very cool, and you can do wonders with cameras these days. So you want to also double check everything on the property overview and amenities. And this is really easy to do. You can go online to their website as well as apartments.com. But the property overview is going to give you a tour of the grounds, the amenities, and the unit mix. All right. The next section is going to be the financial analysis, and we'll spend a little bit of time here. Okay. In that financial analysis, you're going to get an overview of the debt structure of the deal, the return on the investment, cash flow, various projections. You're also going to get rent and sale comps. Very important here. You want to make sure that you look at the sensitivity analysis. Okay. Because remember, in this executive summary, you're going to get one point of data. We want to understand the whole range of the returns that you can look at. Okay. I'm going to show you an example of this. And then the last piece, it should be the market or sub-market overview. Okay, again, you want to confirm that this is a market that you want to be in, and then confirm the data that the operator is sharing with you. Okay, it's really easy to share all the highlights and everything that's going right in the market. You also want to figure out what the challenges are of the market. Okay, now this might seem like a lot, right? This is everything that you should be doing in due diligence, okay? And you want to spend some time here because, again, you get control when you spend time here and you do the due diligence. We do the due diligence for all of the investments that we put out. We think they're entirely amazing. However, you have the power to do the due diligence as well, and we want you to do it. We want you to challenge us. We want you to ask questions, okay? You should ask questions. Now, that said, maybe you're looking at 10 deals a week and you can't spend 2 or 3 hours each deal digging in and getting through all of this like information. How can we screen this and get you to a yes to move forward or a no to set it aside really fast? Well, I'm going to share with you kind of my like 10-minute like little checklist that I go through. Okay, and I'm going to share with you a tool. But I'm looking to answer these top questions, 10 questions, really quickly from an investment summary. And if I feel all of these things are in line pretty well, I'm going to dig in further. If they're not in line or if something smells off, I am going to pass and save my time for something else. What is the asset class? Okay. Is this there's so many different ways you can invest in real estate. Is it multifamily? Is it self-storage, mobile home park, residential assisted living? Okay. What asset class fits your investment strategy? This is where you got to know your goals, guys. Okay. Also, when we talk about the asset class, is it class A, class B? Okay. Class C apartments. For me, I like base hits. I like class B multifamily investing. I think a lot of investors out there do too. Class A, if it's a luxury apartment, I tend to stay away from. If it's workforce housing class A, I might take a look at it. Class C, I might take a look at that too. There's some money to be made in class C, but class C tends to have higher deferred maintenance, especially at the multifamily level. Okay, a little harder to, uncover all those problems immediately upon inspection. How many units does the property have? Okay, this gives us an indication of the kind of scale. You typically cannot have any full-time staff at the property at 75 units or below. Okay, those type of, you might have part-time people, but we love having full-time employees on the premise to help keep an eye on things. Okay, you can have on-site leasing offices at 70 units or above. So how many units? All right, what's the level of scale here? Getting into some of the returns, what's the equity multiple? What is going to happen to my money projected? Okay, what's the projection on my money for the next 5 to 7 years or during the hold period? The darling child equity multiple has been 2x in 5 years. We try to get as close as we possibly can. I think right now our environment, we're looking at 1.8 to 2. Okay, that is going to be a function of the business plan. What can that operator do with the business plan? What is the internal rate of return on the asset, or known as IRR? Okay, it's really, I know I see investors all the time get really starry-eyed at the annual rate of return, but that annual rate of return number does not allow me to compare investments because it does not take into account the timing of which I get my money back. Okay, that internal rate of return does take into account the timing of which I get my money back. And so that number you can use to compare deal to deal. What type of lending is it? All right. On a larger asset, I would love to see non-recourse lending. Okay. I would love to see, moving on to number 6, like the interest rate being fixed for a certain period of time, at least for the duration of the hold, and options to fix it for even further. Okay. That mitigates my business risk. Reversion cap rate. All right. You're going to, the asset is going to have what we call a market cap rate. What the cap rate is, what is that asset trading at purchase? Okay. We want to make sure the operator is underwriting a sensitivity analysis for the cap rate dropping. Okay. If the cap rate drops, the market gets better. If the cap rate rises or reverts, okay, that means the market's getting worse. We want to make sure the operator is not looking through rose-colored glasses, that they're actually prepping what kind of returns can I generate if the market goes the other direction and gets worse, okay? Make sure that you are looking for those reversion cap rates. Now, the standard has been 10 basis points or 0.1% for every year of the hold. So if the hold's 5 years, you want to see the reversion cap rate being 0.5%. If the hold is 7 years, you want to see the reversion cap rate being 0.7%. This is arbitrary. This is just a rule of thumb, okay? I like seeing sensitivity analysis go at least 0.7 to 1% right now, okay? Especially like if we're at the kind of, we can all agree we're kind of at the top of the market. All right, now are there multiple comps that are higher than the subject property? Now this goes for both sales and rents, okay? We don't want to be the best kid on the block, guys. We want to make sure that the comps, we are somewhere in the middle. We don't want to be the lowest, but we don't want to be the best kid, okay? Are there at least a few comps that prove to us within a reasonable expectation that we can push the value of the property and the rents on the property? Okay, projected rent growth. All right, if we held this webinar a year ago, I would have been telling you look for a projected rent growth of 3% is pretty conservative. Guys, 0% rent growth right now in this market is conservative. Okay, we want to see operators actually not relying on pushing rents 5 and 10% right now. I've seen decks where operators are pushing rent growth at 5 or 10%. Now, here's the thing: just because you underwrite projected rent growth at 0% or 1% does not mean that the operator does not expect to capture rent premiums. Okay, we just want to make sure the operator is being conservative on their analyses. Okay, that's it. All right, under promise, over deliver. For us, we're projecting 0% rent growth for at least 12 to 18 months. However, we are getting rent premiums on all of our properties right now. That's just happening. Okay. And then what is the projected vacancy? Again, you guys, if we were holding this webinar a year ago, I would have been saying, we'd be looking for vacancy at like 3 to 5% projected vacancy. Okay, not getting too starry-eyed and saying 0% vacancy. Now, I would want to see at least 2x, if not 3x, market vacancy. So if the market vacancy rate is 3%, I want to see at least a vacancy rate of 6% being underwritten. Why? Not that the units are going to be actually go vacant, but we can underwrite for economic vacancy right now. All right. we've just extended eviction moratoriums through the end of March, and it looks like they're going to go through the end of September. Okay. Now, it is actually incredibly hard for a tenant to qualify for an eviction moratorium. It is proving to be extremely hard for a tenant to qualify. However, we want to be very conservative on our underwriting as well. Okay. Now, these are the 10 questions that I ask myself. Now, how do I get through this really quickly? Well, I have a checklist. Okay. So here is, I would put this checklist for more of an underwriting of like a C+ or a B class property. Okay. And they still hold true in this market. Okay. So my ideal criteria, I'm looking for, and this is me. Okay. If you're looking to invest in A-class apartments, you're going to shift your criteria. Okay. You maybe put the second column as your first column because your numbers are going to change. All right. But I'm looking for B or C class deals. I'm looking for 100 units or more. I want my equity multiple in a 5-year hold to be close to 2x. All right, maybe you have a different tolerance level, right? You want to develop this for yourself. Guys, take a screenshot, okay? You want to develop a checklist like this for yourself that helps you screen all these deals hitting your inbox. I'm looking for deals that have non-recourse agency debt. I like Fannie or Freddie. Why? Because if you were on our supplemental loan webinar where we talked about supplemental loans and refinancing, Fannie, Freddie loans, Fannie Mae, I can do one supplemental refinance at 12 years. If it's a Freddie Mac loan, I can do a supplemental, or 12 months. Sorry, guys, did I say 12 years? If it's a Freddie Mac loan, I can do a supplemental loan every 12 months and pull equity from the project. I want my loan interest rate locked in for, I would say 5 to 7 years. It's probably more prudent at this point in time. I want to see a reversion cap rate of at least 0.5%. I would err probably closer to 0.7. I want to see multiple comps higher. I want to see projected rent growth of less than 3% per year. I don't want my operator being starry-eyed, guys. And I want to see projected vacancy conservative, definitely in the 5 to 10% range. Okay, still good. If it underrates at 10%, that's amazing. It tells me they're being extremely conservative. For us, we're probably going to underwrite right now in our growth markets, definitely in the 5 to 10% range. Okay. Other things that you can consider to add to this list are putting in a checkbox for break-even occupancy. For us, our buy box, we're looking at a break-even occupancy of 65% or lower. Okay. Our last 3 projects were in the 50s. Okay, that's in a COVID environment, we're in the 50s. Okay, that gives us a very healthy spread to pay all the bills and make distributions for our investors. Okay, again, we want to see that full range of a sensitivity analysis. Okay, we don't just want to see one point in time. I want to make sure that IRR is appropriate for the class and the whole time. Okay, here we saw an IRR of over 16%. That's ideal for a B or C class. I think it's super hard to expect an IRR of 16 or 17% for a Class A deal. Okay, you need to make sure that your expectations and returns are aligned for the type of class you want to go into. Can the interest rate especially if it's interest only, be extended? All right, and we already talked about it. COVID specific things. I want to make sure that the operator is underwriting lower no rent growth for 12 months, 2 to 3x of vacancy rate to accommodate for economic vacancy. Also, are they extending the construction timelines? And that's to account for supply chain issues as well as if there's any additional shutdowns that have to happen and they can't get into the units to actually do construction. All right, you want to ask about that. And then you want to make sure that the income rent growth is not aggressive. Okay, so you want to rule out any aggressive income growth. Okay, all right. So are you guys ready to dive in? Should we take a peek at an investment summary? I've done a lot of talking here. Let me see if I can pull this up real fast. I am gonna pause this. New share. All right. I think I got it. Okay. So here was one of our last deals that we did in December. This is Riverside Flats. This actually is a Class A deal. Okay, but remember, let's go through and pick apart this information. Here, we've got our table of contents. For us, we do the executive summary, kind of like an investment profile, the financial analysis, market overview. And then we'll also include our portfolio in there, but not all people include their portfolio, but I think that's becoming more commonplace now. But here's what you can expect to see on one of our investment summaries is that just kind of like overview of what the business plan and what to expect at the property, okay? We've got our entrance cap rate of 4.7%. If there is, oh, you guys can't see the summary? Thanks for telling me. Can you see it now? Woohoo! Technology. Okay, I thought I mastered it, but I guess I didn't. All right, there you go, guys. So there is the executive summary. Thank you for not letting me get too far into that. But we've got our entrance cap rate of 4.7%. Reversion cap rate, we'll look at page 15 here, but that's going to show you the entire spread of the asset, okay? We've got our occupancy, 97%, but we've got to dig elsewhere to find the break-even occupancy. The debt service coverage ratio, 1.28. That's going to give us a little bit of indication on what the debt is on this project. You got your hold time, and then this particular project had 2 tiers for returns. So a little wonky. It's not as straightforward as it was on that checklist sheet. But so that's going to be, again, I'm just going to give you guys a little tour. So here is the executive summary, and then we're going to go into the asset information. Oh, so this is kind of like an overview of like the asset, okay, the market, what we can expect at the location, the grade of the asset, and then our loan plan on the deal. And then the numbers, okay? You'll see a graph like this on equity structure. This is telling you about the capital stack, okay? You guys, I'll send out a replay. If this is confusing to you, make sure to watch that video on the capital stack. In this case, the stack is reversed, okay? Instead of the debt being on top, the debt's on bottom. But as you can see, we've got our senior debt. They are in the highest, lowest risk, lowest reward position. And then we get our limited partner and then our general partner, okay? Our limited partner A, limited partner B, and then the class C, which is the general partner. Okay, here we are naming the preferred returns to the investor. Okay, I guess this is in the investment summary. So in this class A, we've just got a straight preferred return, no upside in the equity. And then in the B class, they have preferred returns, the equity split, and then we also have an IRR hurdle. Okay, and again, if you don't understand these numbers, look for the replays when I send out that recap email. Awesome. Here is the investment summary, okay? What we can expect year over year in the hold of this asset. This down here is going to show me my, right here, the return summary. You guys see right here? This is where I'm seeing my sensitivity analysis, okay? So remember, my entrance cap rate was at 4.7%, all right? We want to make sure that we're writing, underwriting above and below, okay, and that you are okay with the returns above and below the market cap rate, okay? And we always include, you guys should look here, there's a little link right here, where you can actually type in your blended return calculator and figure out, like, if you invested in a deal that was 2 tiers at different IRRs, what you could expect for returns. So that's super helpful, okay? Then we go through the investment offering. This is what's happening at the project, okay? The number of units, square feet, the unit mix. What is the business plan? You guys want to understand what the business plan is, okay? This particular project, we took a 5-year tax abatement in order to save us an immense amount of money, all right? Then we get into the market, Okay, again, you want to just make sure that there are a quick glance, right? This is not meant to be your full on due diligence, guys, but a quick glance. Where do we land? Where does this land in comparison with other units? Okay, where do we compare? Are we somewhere in the unit mix? All right, and then we're getting into our market fundamentals, rent growth, and supply and demand. All right, and then you're going to get into the market data. Okay, but again, high level setup. I'm going to stop the share on this and then flip back to the other one. Okay, so again, you want to create a checklist like this for yourself so you can just go through bam, 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 bam. All this information might actually be in the email body that you get. And you may not even have to look in the investment summary. But even then, just do like a high like little filter. And if it passes through this filter, if most of these boxes hit in your ideal check buy box area, then and only then do you dig deeper. Okay, guys, this was a pretty intense webinar. I hope you guys set up the system for yourself. Okay, just a few closing remarks. Again, don't just look in the investment summary and like write a check. You want to make sure that you are screening this, you're doing your full due diligence, that you are talking. If you have any questions at all, you are talking to the general partners of the project, either on their investor call, or if you can't make the investor call, listen to the replay, email them, and then just confirm all the details by taking the time to research the team in the market as well. So with that, I want to leave it open for some time for questions. If you guys want to pop over to the chat box and let me know what questions you have, and we can take it from there. And while you guys are typing in your questions, I will also let you know about the Goodegg Investment Club. If you guys aren't already a member, make sure to go to goodegginvestments.com/invest. The club is for anybody, whether you're starting out doing this on the side, haven't done a deal yet, or maybe you're a seasoned pro at syndicated investing. You're doing this full time and you have several deals under your belt. This club's for you. This club is where I'm able to share my deal flow with you guys as well. So make sure, especially if you're an accredited investor, majority of our investments this year are going to be accredited only. But anyone can go over there. You get some extra goodies as well. So go over to the Goodegg Investor Club. Make sure you sign up there as well. And I know we went a little over time today, so if you have to drop, thank you so much for investing your time with me and in yourself. Here is my contact information, and I am going to switch over to some questions. Can you share this deck with us, or will it be available on your website to view again? So if you sign up for the Goodegg Investor Club, you can see some of the decks that we share there in the Investor Club. Unfortunately, I cannot share this particular deck with the email list. But if you go over to the, sign up for the Goodegg Investor Club, work through the process, yes, I can send a few other decks over for sure. Awesome. Yeah, you're welcome, Susan. Thanks for joining. All right. Well, I'm going to hang out here a few more minutes, answer any questions that pop up. Thank you guys again so much for investing your time in yourself, and we'll see you next week.